Okay, this is our next chapter, standard cost and variance analysis. So actually we know that standard cost means the cost of producing one standard unit of output. It is something which we use in traditional business environment. Like you have topic budgeting, standard costing, and then you go to variance. So standard cost actually is the cost of making one unit of output. Like if you want to make one table, so what is the standard cost of making one table? $30. That's standard cost. And budget is actually for the total output. Budget means that if you have to make 1,000 tables, so you say one table is $30, 1,000 tables are $30,000. So $30,000 will be your budget. So budget is for total output and standard cost is for one unit. And then what happens that, for example, next month you decide to produce 1,000 tables in one period, and you start making the tables, and end of the period, end of the month, you see that how much did you spend. So you find out that you spent $32,000. So you spent $2,000 more. Your standard cost was 30. I mean, your standard cost was 30, budget was 30,000. But actually you spent 32. You spent $2,000 more. That $2,000 more actually will decrease your profit because your cost is more. And this is called variance. But what we need to do, we cannot sit down and say that, we lost 2,000. We need to investigate that where did we make mistake? Where did we spend more? I mean, when you have a standard cost of $30 for a table, so inside of standard cost, you have standard material, let's suppose $20, standard labor, let's suppose $5, standard overhead, maybe $5. So a standard cost of $30 includes standard material cost, standard labor cost, and standard overhead. And we need to find out, did we purchase material more? I mean, did we pay more for material, which means the price variance? Or maybe we used material more, which may be the usage variance. Similarly, probably the labor cost, if you talk about, maybe we paid to labor more. So when you pay to labor more, there could be two reasons. Either your pay rate was higher, your wage rate was higher, or number two, probably the labor was not efficient. They were taking more time on making one table. So ultimately, we need to find out that what is the reason of this 3,000. And that when we break it up, we call it variances. So variance is like the difference between the actual result and the expected result. How much it should have been and how much it was. It should have been 30,000, but it was 33,000. $3,000 is the variance, and we need to analyze it. This is our general topic. It is one of the most important topics in ACCA F2. I mean, if you ask me, I would say that the costing part, like absorption, marginal, and process costing, and the variance analysis, you get maximum questions in exam. So here we start. We say that standard costs are predetermined. We decide standard costs at the beginning of the year. They are used for planning labor, material, and overhead requirements. Like you agree that, I mean, you set down as a planning measure that one table is 30. Within one table, material is only 20. Within one table, labor is only 5, and etc. And they are benchmarks for measuring performance. Like end of the month, you see that what was our target, what we should have done, and what did we do. So if you are making tables within 30,000 or maybe 29,500, I'm happy. I say you did good job. But if you spend money more than 30,000, then we will ask you that why did you spend more? And when we say we will ask you, we call it management by exception. Management by exception means that management usually interferes in those areas which you are, crossing the boundaries. Like, for example, if you have 100 people in office, you never come in and says who was in time. So I go in and say, who was late today? And they told me, oh, there are two people, A and B, they were late. So then I ask only A and B, please come in and tell me why you were late. So it is called management by exception, that wherever you exceed the standards, that is the time where you ask people. So we call it management by exception. Management by exception means that you have set standards. There is a direct material cost, maybe $20. So as long as it is $20, it is okay. Whenever it increases than 20, then you will find out the reason. So you set standards, okay? You've got standard for overhead, standard for labor, standard for material. So anything which goes beyond standard, that is something which you need to investigate. And what is the standard setting process? Like who sets the standard? So you should remember that standards are not set by one person in a company. Standards are set by a team like accountants, engineers, administrators, production managers, everyone together. Because production manager will say that I need 2 kilograms of raw material. Then procurement will tell the price of the 2 kilogram. Similarly, production manager will say I need 5 hours of labor. Then HR department will say that what is the cost of five labor hours. So everybody together you set standards. So should we use practical standards or ideal standard? This is something which we discussed in our last chapter. Ideal standards and achievable standards, you can refer to the previous lecture. So this is from the previous lecture. So you have price standard. So there are two price standards, like you call it, the price is about, for material. If I talk about material standard, there are two: material price and material quantity, which means that how many kilograms I should use and what should be the price of each kilogram. So you are making some product which uses 5 kilograms of material. So 5 kilogram is called quantity standard, and each kilogram is $2. So $2 is the price standard. And together 5 kilogram multiplied by $2, you say that $10 will be the cost of material within 1 unit. Similarly, you have labor standards. Labor standard, again, you set for two. You have labor rate standard, which means that what is your wage? You say we pay $5 per hour. That is rate standard. And how much time is required on 1 unit. So one table we make, one person should be making a table in 2 hours. So $5 per hour and 2 hours should be worked. So you have got rate standard $5, time standard, which is 2 hours. So $10, the cost of labor. So labor also you have, then you have variable overhead standard. Variable overhead also has two. One is called the rate standard, which means you call it, spending variance, spending, that what is the variable overhead rate, $2 per hour, $3 per hour. And then the activity standard, it is just like how much time of overhead you will spend. So you call it variable overhead activity standard. So there are two variances for material, two variances for labor, and two variances are for variable overhead. So a standard cost card, it will look like this, that you have, first you say that direct material, 3 pounds, where each pound is $4. So it means that $12 is direct material. Direct labor could be 2.5 hours, where each hour is $14, and the cost of labor is $35. And then you have variable manufacturing overhead, 2.5 hours into $3. You should remember that variable overhead is usually calculated as the labor hours. So whatever labor hours you work, the same number of labor hours, they go for variable overhead. Rate can be different. Rate is $3. Before it, I mean, for labor, it is $14 per hour. For overhead, it is $3 per hour, but the number of hours are same. So you come up to be $54. This is your standard cost of producing 1 unit. So this is how you make standard cost. But then what happened, that in reality, when you will make your output, you will see that you did not make the unit for 54. Actually, you made 1 unit in $58. So when you made 1 unit for $58, you need to find out, that why this difference appeared. Okay. Where did you spend $4 more? So maybe you purchased material expensive, or maybe you used material more. Maybe you paid more for the labor, or maybe people worked more number of hours. And probably your variable overhead hours are more, or probably variable overhead rate is more. So what you can say, that These are actually my variable cost. If you pay attention, I did not write down here fixed overhead or fixed cost. I only talked about variable cost. So when you talk about variances, variance means the differences. There are, for variable cost, there are six variances. There are six variances for variable cost. Two variance for direct material, like one could be here, one could be here. This one will be called material usage variance. Maybe I used more. This one will be called material price variance. Maybe I purchased expensive. Then for labor, you again have two variances, which means that maybe our efficiency was less and we spent more hours. Instead of working for 2.5 hours, we made one unit in 3 hours. Or maybe our efficiency was not a problem. The problem was with the rate, because we hired people expensive, we gave them more salaries or wages. And then you have two variances for variable overhead, again for the number of hours and the rate per hour. So in total you have variable cost variances, and there are six variable cost variances: two for the material, two for the labor, and two for the variable overhead. After that, we will do fixed cost variances, then we will do sales price variances. Anyways, this is the situation. Now, let me go back and tell you what are we trying to do. What happens that you have your budgeted profit. When we were doing budget, we talked about that we have budgeted profit. Budgeted profit means expected profit. So beginning of the year, when we started our year, we thought that our profit should be, $100,000. But then we started doing the work and our actual profit, it comes out to be, say, $85,000, okay? Or let's call it $80,000. Our actual profit is $80,000. So it means that there is a variance, a total variance, I would call it, which is $20,000. You made $20,000 less. You need to find out the reason. You know why? If you do not find out the reason, next year you again will not be able to achieve your target. So we know that we did not achieve the target, but we want to find out who is responsible, what happened. Maybe we purchased expensive material, or maybe we used more. You know what will happen? You will find out that your direct labor has a huge variance. Your direct labor has $7,000 adverse variance, which means that you spend $7,000 more on the labor side. So you call in the production manager and you say that, you know what, guys, because of you, we lost $7,000 because you spent more money, probably on labor hours. You are spending too many hours. We actually planned to spend 2.5 hours on making one unit, but you are making 3 hours per unit. And we have to pay more money to the people, and therefore we are in loss. Please tell us, why did it happen? And then the production manager will say that, see, this is not my problem. The equipment, the machinery which I have, this one machine is not working good. 3 days it works and then it breaks down, and then we bring in the maintenance department and they are repairing the machine for next 2 days, and my people are sitting idle, but I have to pay them money because their time is wasted. So if you repair this machine, or if you change this equipment, next month it will not happen. So he told you a problem. So through variance analysis, you actually identify the problems. What are the problems in your company? And then you have to find out, okay, now this machinery I need to repair. So if you repair the equipment, next month it will be good. But if you do not repair the equipment and you keep the things as they are, next month, again, you will make a loss. Again, you will not achieve your objective. So what we do, that we need to prepare a report, which is called an operating statement, for reconciling this $20,000. because this $20,000 did not come from one way. Maybe 7,000 is coming from here, 5,000 is coming from here, and probably 8,000 is coming from here. But then within this 5,000, it also belongs some part here, some part here, because maybe you purchased expensive, maybe you used more. I mean, what is the reason for this 5,000? If you buy more, if you paid expensive, if your purchase price is $5 per pound, then you go and talk to the purchase manager. You are buying goods expensive. But if it is about the time, like I'm sorry, the usage, like instead of using 3 pounds, you are using 3.5 pounds. So then you talk to the production manager. So not time, I'm sorry, it should be usage. So material has two things: the usage, which means how much we are using, and production manager is responsible for that. Ask this person. But if you are buying it expensive, it is called price variance. Then the purchase manager, the procurement department is responsible. So we analyze our business numbers here. So this is a little bit of background. So we discussed this thing before. I already have explained it. So I see that there's an unfavorable variance. So there are two types of variance. You call them adverse variance and you call it favorable variance. Adverse is also sometimes called unfavorable. Unfavorable, but usually the word is adverse. Adverse variance is that variance which will decrease your profit. Like cost is going up, it is adverse variance. Favorable variance is a situation which increases your profit. Cost goes down, it is a favorable variance. So what we do, we actually prepare a standard cost performance report, analyze variances, identify questions: what is the reason, what is happening, receive explanations from responsible people, take corrective action like change the equipment, conduct next year operation, go to the next period, and then make the report again. So this is how it works. Standard cost variances. When it comes to cost, you have two variances. You call it, I'm talking about first material thing, okay? So for material, you have material price variance and material quantity variance. Quantity variance also means usage variance. Quantity variance or usage variance is same thing. So there are some formulas which are given in the book, which are also given in my slides. For example, they use these formulas. I will not use the formula because there are 20 variances. So it is actual quantity into actual price minus standard price. Forget about these formulas, okay? We will be doing it not with the formula, we will be doing it logically. So let's use the general model to calculate the standard cost variances for direct material. You should remember that doing with the formula will never make your life easy. It will give you a lot of trouble. What you keep in mind, that variance is like how much it should have been and how much it was. Let me first explain you a very simple example that how this variance thing occurs.